Great. Well, welcome to today's event on the psychology of investing. My name is Eric Hutchins, CEO of Allodium Investment Consultants. Two quick householding items. The Q&A panel is open, so feel free to submit questions and Scott will answer them depending on time. Secondly, after today's session, a short evaluation will pop up that we encourage you to complete. I want to thank Dimensional Fund Advisors, who has been a great partner for Allodium for well over a decade. And today's speaker, Scott Bosworth, is head of Dimensional Speakers Bureau. In addition to being a frequent presenter at Dimensional conferences and industry events, he manages the firm's primary team of speakers and helps develop messaging around key investment concepts. Scott has been with Dimensional since 1996, first as a portfolio manager, then working with institutions and large advisory clients. He is a CFA, graduated from James Madison University, and earned an MBA from Yale. Scott, I've had the pleasure of hearing you present in the past, and I'm confident we'll learn more today about the psychology of investing. Thanks for being here.
Yeah, thanks, Eric. I hope so. This is an entertaining talk. It's entertaining to give. I mean, I've been giving this talk for 15 years, a version of it, and it's a sort of a hobby of mine. I'm not a professor of psychology, but I feel like I could almost teach at least a layman's course on it, given how much I've read over the years. And this really stemmed out of advisor interest and their client interest in behavioral psychology and behavioral finance coming out of 2008, 2009. And so that's when I started really digging into this as a hobby and developing a presentation to sort of walk through what I think are some of the key things to understand, because there's a lot of press about this. There's a lot of media attention, a lot of papers get written, a lot of news media columnists talk about psychology and behavioral biases. And I think the term that often gets bandied around is this idea of, we're all irrational. We're all making all these massive mistakes. And, if only we could, cure ourselves. And I want to start by saying that would actually be a bad idea. And I'll unpack what I mean by that. And we'll kind of go through a few different concepts around behavioral psychology, behavioral finance, and sort of implications for you as you think about your long-term investment journey. And also, I think, if I may be so bold, I think some of the stuff you learn here as we unpack this will help you in other parts of your life as well. And I think be able to figure out where to place all this information and how to just basically maybe navigate a lot of uncertain environments with a lot less anxiety. So I kind of want to get started with a picture here. Sorry, I'm getting my cursor right. So hopefully this might be a person familiar to some of you. If you're familiar with portraits, this is not probably the most famous portrait of Sir Isaac Newton, but it is one of the more popular ones. And this was, he's the reason I show Newton, Sir Isaac Newton, at the beginning of this talk is, if you want to think about somebody who was as well connected to finance, he was the controller of the currency of the mint in England for about 30 years, towards the end of his career. He lived a ripe old age of 80-something, died in the late 1720s. So this is 300 years ago. We have a really smart individual, and he's known for a lot of things. If this were a live audience, I would quiz you. What kind of things did Sir Isaac Newton invent or contribute to? And the list is extremely long. So not only was he one of the smartest men, the smartest people that was around during his time, he's probably one of the smartest people ever. And yet, even he succumbed to what we would call today sort of irrational behavior. So when you think about Sir Isaac Newton, the part of his life I'd like to focus on is in the spring of 1720. He was an investor. I like to say he was a globally diversified investor, which is to say he owned all 8 stocks that you could trade back then. So it didn't mean what it means today. He was also, I would say, very much an insider. When you think of the South Sea Company, which was the stock that is often associated with the bubble economy, as it was called in hindsight, the bubble economy of 1720. So he's an investor. He's got his money spread around. He's very wealthy for the time, and he's collecting his coupons, his what we would call dividends today. And when I say he's an insider, I mean this is he could call up the board of directors, which you weren't called a board of directors back then, but he could call the board of South Sea Company and tell them when he'd like his dividend paid and what he would like it paid in. So imagine you could call up Jeff Bezos or the board of Amazon and say, you know, I'd like my dividend paid next Friday, if that's okay, and could you pay it to me in treasury bills and Bitcoin? You maybe half and half. I mean, that was the type of control and the type of knowledge and the type of insider access that someone like Newton had. And what he found was, this stock didn't do much, right? It's about 100 pounds, about 120 pounds sterling, kicking off a dividend of roughly 5%. He was a wise investor, and he knew irrational behavior when he saw it, because in the spring of 1720, this stock almost tripled in value over speculation. A lot of the same kind of stuff you hear about today with meme stocks or that sort of thing. And so he's like, okay, this makes no sense. I am a very smart person. I am well connected. I am going to sell my shares. And he did, and he made a very handsome profit. I mean, this is 300 years ago, and I think the profit on this trade was something like 20,000 pounds sterling for Newton. But here's the problem. Here's where it starts to get a little bit interesting, is that it kept going up. So despite the fact that he recognized an irrational run up in the price of the stock, he had opinions about whether it was speculation. He knew it wasn't real valuation. He knew there was some shenanigans going on, but he had to have this regret over selling too early or maybe selling at all. And so I'm not going to belabor the story. Many academic papers have been written, books have been written about the bubble economy of the 1720 era. Well, and I know you're probably grimacing a little bit right now. You can probably empathize with the emotions that he was going through, but he took that money and his original investment and he put it all back into the stock. He couldn't take it anymore. He couldn't take that regret, that fear of missing out. And as it unfolded, it didn't go up much more after that. And Newton basically exited in a series of trades in the later summer and fall of 1720, and it kind of wiped him out. Now, it didn't wipe him out entirely; it just wiped out his position in the South Sea Company. He lost that 20,000 pounds. So his net here was negative 20,000. He died about a little less than 10 years after this, at the ripe old age of, I think, 84 or 87. I don't remember. I should probably memorize that number. So for the time, lived a great life, wealthy, died with about 30,000 pounds for an estate. So 20,000 loss was a huge fraction of that, which is a cautionary tale. And I bring this up because it's been written about a lot. One of my favorite authors, Jason Zweig, in the Wall Street Journal, has written about Newton. That's where I first got turned on to it. But the interesting thing about this is that oftentimes people think they can sort of educate themselves away from these biases. They can be smart enough. If I'm only smart enough, I can somehow, not succumb to the emotional biases that will infect a lot of other investors. Secondly, they may say, well, this is a new thing. It's because of social media. It's because of all of the 24-hour news cycle. That's why we have all these emotional problems with investing. Or it's a third thing, which is, well, I just need to be connected. If I know the people, if I know the business, if I'm really familiar with what the goings in and outs are, then I'm not going to succumb to that. And Newton really strikes out on all three of those primary defenses that people often put up to debate this idea that they can somehow immunize themselves. So it's an interesting story to get us this started, but I want you to understand those are the three big takeaways. Intelligence, being an insider, and this is not something new, right? As a matter of fact, we could go back to 100 years before this with the tulip craze in Holland, and that was another bubble, and that was 300 years ago. So that's the cautionary tale for Newton. And there's one last little nugget that I will leave you with Newton, and that is that he has some famous quotes, but among them is this idea that he can calculate the motion of heavenly bodies, but not the madness of people. Now, why do I like this quote in the context of a behavioral talk? It's because this sort of tells me where his emotions were during this period of time with the South Sea stock. He was blaming his misfortune and his anxiety, not on his own issues, but on the sort of stupidity, if you will, or the madness, if you will, of everybody else. So, he's telling you, oh, by the way, I'm really smart. I can calculate, the motion of planets and stars, but everybody else is way behind me, and that's cost me, a small fortune. This is something that we'll talk about a little bit called what I will call attribution bias. And what attribution bias is, it's something we all have. You have it. It's I'm sure come up in your lives. I've had it. When things go well, we often sort of pat ourselves on the back and say, that was such a good decision I made, such a good trade I made, and look at how well I've done. It feeds overconfidence, another item we'll get into in a minute. But when things don't go well, we oftentimes don't take our share of the blame. We usually look for externalities, other people, or other events that we claim we couldn't have seen coming. And look, that's a psychological defense. I'm not suggesting it's bad because it makes us feel better, helps us get out of bed in the morning when things aren't going our way. But it is a problem when it comes to how it might infect future decisions based on attribution or confirmation bias. So the very first book I read, this was actually published by Jason Zweig. I mentioned him a minute ago. He's a columnist for the Wall Street Journal and an author. He actually wrote this book in 2008, and I picked it up late that year, early 2009. It was the first book I read. And this quote, which is in the first chapter of the book, really stuck with me. This idea that the theme of this book is that our investing brains drive us to do things that don't make any rational sense, but they make perfect emotional sense. And he points out that does not make us irrational. It makes us human. And so I want to pause there and say, if you're listening to this, if you're familiar with this body of work by Zweig and Kahneman and Dick Thaler and others, take a moment to say, give yourself a little grace. This is how we're wired. It's not going to go away, but we can put tools in place to help us manage it when kind of the stakes are high. So this is a great message. I read this 15, 16 years ago now, and it's stuck with me ever since and has sort of guided my narration through this hobby of investor psychology that I've picked up. So here's Daniel Kahneman. Him and his late partner Amos Tversky. Well, Kahneman's now passed away as well, but Kahneman and Tversky were sort of the founders, if you will, of the research into decision making that we know today as behavioral psychology and the offshoot of that, which is behavioral finance. And I think a really, really basic kind of amygdala place to start is this idea that we are survival animals, first and foremost. And that survival instinct is going to give priority to bad news over good news. And we're not going to, we would much rather make an error that expends a little bit of energy, but we can survive rather than make the error of ignoring danger and having that be the last thing we ever do. So you don't get to make those mistakes twice when you think about like primitive kind of human minds. So understanding this concept is a good leap. Most people get this, but obviously the media does too, right? And this is not anything terribly new. This was from 2010, The Economist. I just love this cover. I mean, if I saw this on a newsstand back in my airport newsstand days, I'd want to buy this magazine and pick it up. It's sort of catchy. It's sort of eye-catching. But it is definitely trying to stoke that fear that we need some sort of help to avoid disasters. And fear doesn't always come in that same package. Sometimes it comes with this like FOMO wrapper. But if you think about how news media is packaged, it's oftentimes this idea of either, things are about to get really bad because all the news is bad, or things are good, but you're not capturing your fair share. And I think both of those are tickling the same emotion, that fear emotion. Either it's a fear of that survival instinct kicking in, or it's a fear that we're missing out on something better. An analogy I like to use, And I use these analogies loosely when I think about uh, comparing investing in the stock market and bond market with gambling. But I do like this metaphor, which is it's like this idea of FOMO is like if you play roulette, you have two options. If you're betting conservatively, which is sort of an oxymoron, but you're betting on roulette, you bet on red, let's say, and you have almost a 50% chance of winning that bet. So the marble spins around the wheel and it does land on red. And instead of being happy, you're upset that you didn't bet on 12 red because you would have won a lot more money had you concentrated your bet. But of course, you would have had to take a lot more risk and the odds of success would have been much, much smaller. That part of the metaphor does apply to investing really, really well. So we'll get into some of this. The fear and the greed are the two, I would say, triggering and dominating emotions that we feel that feed a lot of the biases that you read about in the media, whether it's overconfidence, regret avoidance, intuition, resulting. We'll cover a few of them that I kind of call, they're not really my favorites. I would say they're probably the most relevant when we think about investing. They're the most relevant and probably the most well documented when it comes to investing. So the first one we'll talk about is overconfidence, and this will be quick. We all have some level of overconfidence, at least in certain parts of our lives. I mean, the famous studies that every professor from here to 100 years ago seems to have done some sort of back of the envelope. How many people think they're better than average drivers relative to the rest of the people in this room? You always get results where people think they're a little bit better than average at most things. Now, that doesn't mean it applies to everybody. It doesn't mean it applies to everybody in every endeavor. But overconfidence is probably the most off-cited of the biases, and it drives a lot of the behavior that that manifests itself in terms of investment errors. I like to say the worst thing you can do if you're like a day trader or trading in options, the worst thing that can happen to you as an investor is to make a lot of money on your first trade because it's going to give you that sense of like, oh, I must be good at this. Again, that's that attribution bias I was talking about earlier. But I love this quote that I'm going to share with you from Charlie Munger, who was the late right-hand man of Warren Buffett at Berkshire Hathaway. And Charlie said, as a cautionary tale, and sort of morbidly, it's the strong swimmers who drown. And you want to talk about an impact statement or a kind of a party crasher statement. But when you unpack this, it makes a lot of sense when you think, if you think you're really good at day trading, for example, you're going to end up taking a lot more risk, the kind of risk that might financially wipe you out if we extend that metaphor from swimming to investing. If you're not really confident in the ocean or in the pool, you're probably going to stay near the beach or in the shallow end. It's the strong swimmers who are going to put themselves out there and perhaps put themselves in more danger. Confirmation bias, I talked about this already. We'll get a little bit wonky here, but I think it's interesting to understand confirmation bias and its sort of offshoots, one of which is this idea. It's got a funny name because the professor that came up with it, Semmelweis reflex, but it's this idea that there's an intuition we all have to reject information that's going to contradict our current beliefs. And this happens in all kinds of parts of our lives, politics, religion, family. But of course, when it comes to money, we're not immune to it here either. And I want to be honest. I want to give everybody a little bit of grace here. This is normal. It's a defense mechanism to keep us from changing our mind constantly and making a chaotic world even more chaotic. So there is a reason why we have this intuition, but I would be aware of it so that we can be open-minded, understand that there are other ideas around, everybody's panicking because of tariffs. Well, the market so far has done, decent, especially non-US investment has done decent in the face of something that our intuition might have told us, if this is all going to unfold like this, there's no way the markets are going to survive this type of onslaught. But they, in fact, did. So our intuition there would have been wrong. And that's where we want to rely back on our plan. We want to have sort of little life hacks to be able to remind ourselves, okay, I have this feeling. It's an instinct, it's an intuition, it's in my gut. That's okay. I don't need to scold myself for having an intuition, but I need to have like what I call an accountability partner. And an advisor is a great accountability partner for this sort of thing. They're gonna come back and say, you know what? Are we on track to meet our goals? Has anything materially changed in your goals or your situation that we might want to revisit your investment and financial plan? If not, let's not react to the news or the soup of the day. Pattern seeking. This is a big one. It's fun. I'm going to share a little example with you. This is from Kahneman and Tversky's paper back in 1974, kind of the seminal paper that launched this field of study called Judgment Under Uncertainty, Heuristics and Biases. And they unwrap some stuff, one of which I found this fascinating. It's called representativeness. So here's the example I want you to imagine. Consider a coin that I would flip in front of you, and maybe I would write the sequence on the board. And you all watched it live, so there's no tricks. It's a fair coin. And then you're asked very simply, if you imagine a scenario like that, which of these sequence of flips is more likely, A, B, or C? They give this test to all sorts of people that are well-schooled in statistics and probability, random grad students at their universities when they taught, and overwhelmingly people picked A. And the reason they found this interesting is with a little bit of what Kahneman would call system two thinking, that hardworking but non-intuitive brain where we actually have to crunch the numbers, you're going to figure out the answer to this if you spend some time on it. But if you use your intuitive brain, you're going to get it wrong. The right answer is actually all three of these are equally likely. There are 64 possible sequences when you flip a coin, and all 64 of them are equally likely. The reason people like A is because it's more representative of what we think of as a fair coin, right? You got 50-50 and it's sort of randomly dispersed. B sort of violates the randomness principle and C violates the fairness principle. So we just don't like those. And this may seem overly simplistic, but this has larger ramifications for investing that I'll mention to you now, which is, let's imagine that you witnessed me flip the coin and you saw the sequence of C come up. Heads, 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 tails, heads. Or better yet, maybe you saw me flip 6 heads in a row. And then I asked you, okay, everybody gets to gamble. What is the next flip going to be? What is more likely going to happen with the next flip? And if you are intuitive, like me, you're probably your brain is going to whisper to you that you probably want to bet on tails. Why might that be? The logical brain knows that a coin doesn't have a memory, but the intuitive brain says tails is due, right? It's got to be due. We got to get some more tails in here to balance this out. But that's not how statistics works, right? We get dilution, so you might have runs of tails later in the sequence. But if we flip a coin 100 million times, there are not going to be 50 million heads and 50 million tails. There's going to be a pretty wide gap between the heads and tails numbers, but it's going to be very close to 50% for each. So the law of large numbers says as you have more and more flips, you're going to get dilution of any kind of streaks in the data, but you're not going to get a reversion to the mean. And again, our logical brain knows that, but our intuitive brain is going to fight really hard. And so hard, I mean, I don't have a slide for this, but on this same sort of subject matter, they've done tests with rats where they'll show like a maze where if they go left, they're going to get fed a pellet of food 60% of the time. If they go right, they're going to get a pellet of food 40% of the time. Now, if you're left, if you had a thinking brain like a human, you know where you're going to go. You're going to go left to get the higher odds of food every time. And sure enough, rats, after a few iterations, they figure it out and they always go left. Even though sometimes they're disappointed, they always go left because their brains figure it out. Humans don't. It's amazing. If you do the same sort of experiment with a human, you tell a human, here's an urn of balls, red and blue. There's 60% of the balls in the urn are red, 40% of the balls in the urn are blue. Pick a ball at random and just sort of like see how it goes. This is even when you're told the distribution, you're told 60-40, and then people still want to occasionally, if they pull a bunch of red balls out, they're going to say, well, I think the next one's going to be blue. Now, of course, I'm not going to get too wonky, but we're assuming replication here, like a coin flip. You don't run out of heads, whereas in an urn of balls, you might run out of red or run out of blue. But in this example, humans continue to want to sort of predict that pattern seeking, even though we know there shouldn't be a pattern there. This is really powerful when it comes to our investment portfolio. We are looking for patterns. Be aware that you're looking for patterns. Be aware that there's nothing you can do about it. But I should say there's nothing you can do about the feeling of looking for patterns. I mean, this is a survival instinct that we're all wired with, but you want to have that accountability partner. You want to have that life hack to keep you from making, really bad and potentially bad investment decisions based on pattern seeking. All right. So hindsight bias is my favorite. Maybe you know who this guy is if you're a football fan. His former team's actually in the Super Bowl, the Seattle Seahawks. Sorry for all you Green Bay fans or Minnesota Viking fans that are tuning in. But Pete Carroll is famous for two things, or famous for one thing and infamous for the other. He's famous for being one of only three football coaches who have won both a national championship in college and a Super Bowl in the pros. He's infamous for probably making what is widely known as the worst play call of all time in a Super Bowl. If you're familiar, it was Super Bowl 49. It's actually a rematch of the same two teams. If you're a football fan, Seattle and New England are going at it again in Super Bowl 60 coming up in a couple of weeks. But this is a funny sort of armchair quarterback moment, which the football nerds absolutely went bananas over. So on second and goal with the game in hand, they passed instead of run. And they had a really good running back named Marshawn Lynch. The pass got intercepted and they lost the game. Had they had an incompletion, no problem. Clock would have stopped. They still had two more downs to score a touchdown. Had they caught the ball, touchdown, they probably win with like a 99% probability. But they got intercepted, which was a highly unlikely statistical outcome, but it happened. So when you think about the decision to make a play call there for a pass, what we're doing with hindsight is they're saying, oh, that was a terrible decision. I guarantee you, had it been incomplete or completed, everybody would have been calling him a genius for the exact same play call. And this is something that I learned about, first of all, in this book by Annie Duke called Thinking in Bets. She's a former professional poker player. She's now a consultant to Fortune 500 type companies. And she talked about hindsight bias, its tendency. This is the psychology definition, not hers. Once an outcome is known, we see that outcome as having been inevitable. We should have known this all along. In poker, they have this thing called resulting. It's our tendency to equate the quality of a decision with the quality of its outcome. And we're seeing this in investing today, right? I mean, for the last several years, people have been like, well, why am I invested internationally? Why do I have all this non-US exposure in my stocks and bonds? The US is dominating from a performance standpoint. Or why don't we have more gold in the portfolio? Or what are we doing about AI? There's all this resulting going on in people's brains because we think it was inevitable that this is what was going to happen. But diversification back then, even though it resulted in a lower return on our portfolio, it was the right decision to make, and it still is the right decision to make today. So this idea of resulting, I think, is really cool. It's a cool term. I suggest you sort of write it down, memorize it, remember it, because it is something that we're all subject, myself included, we're all subject to this concept of resulting. So it doesn't mean that every decision was right. It just means, be aware when you think your decisions were wrong, that you may be applying some bad math and bad sort of emotional baggage to that internal voice of yours.
Scott, I was listening to a podcast with Annie Duke was on about a week ago, and when she was teaching, she does a interesting exercise with her students where she, at the end of the year, she said, has them all write down what was your best decision of the year, and what was your worst decision of the year. And
I love it.
you could use investing, you kind of relate it to investing, but then she'd say, okay, of your best decisions, how many of those, how many times was the best decision did it make you money, or the worst decision, how many times did the
Right.
your worst decision cost you money? And it was always 100%. 100% of the best decisions were ones that made money. 100% of the worst decisions were ones that lost money, and just how much that's clearly we're looking at the results, and that's what's driving whether we
Yeah.
thought it was a good decision or a bad decision.
Well, that's a great exercise. I don't do that myself, but I actually should. And I think people, whether it's with investing or anything else, I mean, people should, sort of hold themselves accountable to these biases and these emotions. And I'm not, Warren Buffett said something famous, I think, many, many years ago, where he said, to be a really, really good investor, you almost have to be antisocial. So I always tell people like, try to, I don't want you to make bad investment decisions because of your emotions, but I also don't want you to completely cure yourself of being a human being. So, there is that danger of being a little bit too wonky, a little bit too antisocial with your sort of contrarian views. But to behave this way is really contrarian. I mean, it gets back to this idea of everybody else is chasing things, everybody else is doing the pattern seeking, and you can feel very lonely if you're the one at the cocktail party going, "Yeah, I just buy and hold and rebalance, and I invest globally, and I ignore all these trends and all these hot topics that come up." That can be boring. I personally don't chase them with my money, but I chase them with my attention. So I do know how to talk about Bitcoin. I do know how to talk about AI. I'm really interested in those developments. I love the fact that gold is now $5,000 an ounce. That's crazy. Like, but I don't carry a lot of regret that I didn't somehow see all that coming. So uh, this box here on resulting, I want to underline this point on it makes us believe this idea of hindsight bias makes us think the future is more predictable than it is. That is a what I'll call an encapsulated emotion or an encapsulated bias. You are never going to be able to rid yourself of the sense that hindsight makes the future seem more predictable than it is. Just live with it, but know you've got it and don't let it infect those decision-making things going forward. All right, so we got a couple more, and then I'll sort of wrap this up in the next, 5 or 10 minutes or so. But well, probably 10 to 15 minutes. Framing is really interesting, and most people, if you've done any study of psychology, you've probably heard some experiment around framing. Framing is one way marketing gets us to buy, one soft drink versus another soft drink, or where things are placed on the shelves, or we make decisions based on how the problems are often framed to us. And of course, you go back to the magazine covers I shared. That's partly framing, right? It's getting us worked up. It's getting us primed in a way to lead you to make a decision that may not be suboptimal, but it's more in line with the goals of the person asking the question rather than your goals. And you see this in our investment industry. Allodium sees this. I mean, a lot of our industry has come out of those dark ages, but I would say, investing back 40, 50 years ago was filled with people sort of selling you some product that may not have been in your best interest. But if they frame it in a way that either makes you greedy to get it or scares you that you need it, those were ways that the investment industry would frame products and services to get investors to buy in. So here's an example of framing. This is not an investment example. And in fact, as you read this, you probably realize it's a pretty dated example. This goes back to the 1970s, another Kahneman and Tversky gem. It's called the Linda experiment. And the Linda experiment is a little bit controversial, but we don't need to get into that. I'll explain a little bit what I mean. But if you read this, Linda's 31, single, outspoken. She's bright. She's a philosophy major. As a student, deeply concerned with issues of discrimination and social justice, and also participated in anti-nuclear demonstrations. Well, great. I just described somebody to you. You've now done a stereotype, right? That's another intuitive bias that we have. You have pictured this person. You might know someone like her, and now you're imagining that person. But anyway, you've stereotyped, most of us have. And now I'm going to ask you a really easy question. Just a guess. Is it more likely that Linda's a bank teller or that she's a bank teller who's active in the feminist movement? Now, maybe you spend a second thinking about this and you probably pick two if you're like most people who have taken this test over the last 50 some odd years. Something like 80% more people pick two than one. I mean, it's overwhelming. I shouldn't say 80%, more 5 to 1. So 80 to 20 is kind of the ratio. It's a conjunction fallacy, of course. I mean, that's a technical term for it, whereas all the population of two is entirely contained within one. So by definition, it's more likely that Linda's a bank teller by itself. The fact that she's also a bank teller active in the feminist movement is a conjunction of two things. So from a probability standpoint, the answer is one, not two. But the reason it's controversial and the reason people complain about this is they're like, well, that's not fair. It's a trick question. Why tell me anything about Linda if I don't need that information to make, a probabilistic statement? And when people say that to me, I say, exactly, right? That's the whole point of this, is that we often make decisions, we often make choices when we're given information that is completely useless. Sometimes that information, like it is in this case, actually undermines the right answer, right? It's the fact that we have information about Linda at all is going to lead us to make the wrong choice, not the right choice. So it's interesting. The framing obviously comes up in a lot of different examples, but this is kind of a fun one and one of the original studies that Kahneman and Tversky did on framing. But keep this in mind. This is an information bias. How options are presented can influence our choice, often influence our choice, but framing is more than that, right? It's also about how options are presented. It's how the mindset we're in when those options are presented can also influence it. So framing is a big one, right? It's one to be aware of when you're reading news stories, when you're reading any sort of, opinions about the financial markets or investing in general. So I would just say, again, awareness is going to help. But the last one I'm going to share with you is sort of the one that's going to sort of contradict everything I've said, which is awareness is going to help, but there is this thing, there is literally a bias that talks about the fact that we're bad at recognizing our biases. And it's called the bias blind spot. It's called a lot of things. It's called the G.I. Joe fallacy, which I'll explain in a second. But it goes something like this. Most of these encapsulated biases are visual illusions. That's one example. This is a famous example called the Shepherd's Table. And, you look at these two tables. If you're like most humans, and maybe all humans, the one on the left looks longer and skinnier than the one on the right. That's because of the way we perceive things in 3 dimensions. But of course, you're not seeing it in 3 dimensions, you're seeing it in 2, but your brain makes that adjustment because it's really smart, and that's what it does. It's an intuition that you cannot escape, even though the tabletops are exactly the same shape. They just don't look like it. And so now that you're aware of that, you now know, right? You have the facts, you still see the illusion. So this is what an encapsulated bias is, and it's really important to understand that you're not supposed to fix these things. You don't want your brain to automatically adjust for this and you never see the difference anymore, right? Because that's not how our brains are supposed to be spatially aware. And that's an important thing in our survival, in our life as human beings. So I love this quote. Kahneman wrote a pretty comprehensive book back in 2011. He won the Nobel Prize, by the way, in economics, the Memorial Prize in economics, even though he was not an economist. He never took a single course in economics. He never taught a course in economics. But his work in psychology was so important for behavioral finance that he got a Nobel Prize in economics for it. But he points out, he's like, in the beginning of this book, Thinking Fast and Slow, where he talks about the two sides of the brain, the system one brain, which is this intuitive brain that jumps to conclusions and uses intuitions and tries to cut through the chaos of the world so that we don't have to, be paralyzed every time we have to make choices. System two is that like hardworking but lazy. Well, I guess you can't be hardworking and lazy. It's lazy, but it has to do the hard work, I guess is the way to put it. And it only gets activated intentionally, whereas system one is activated automatically. And he says, look, I'm going to describe this concept to you in this book, Thinking Fast and Slow, which is a great read. It's very dense, full caution there. But he said it's not a case that you can read this book and that awareness is going to help you think differently. He goes, I've written the book and I still don't think differently. And Kahneman is kind of the godfather of behavioral psychology. So I would take that advice very seriously. Get knowledgeable about this. It's fun. I like reading about psychology. I find it very interesting. It tickles whatever sort of sense of curiosity I typically have. You may not have that sense of curiosity, and that's fine. But just know that awareness is only going to help a little bit. And there's this funny little study that was done back in, I think, maybe 20 years ago or so, and an academic came up with this thing he coined the GI Joe fallacy. Now, a little bit of nostalgia here. Cartoons in the 1980s. There was a cartoon called GI Joe, and at the end of the 30-minute cartoon, GI Joe would witness a kid stealing a bike or throwing a baseball through a window and lying about it. And you'd have this little public service announcement where GI Joe would say, hey, that's not the right thing to do. How would you like it if somebody threw a rock through your window? Real basic stuff. And it would say, like, now you know, and knowing's half the battle. And even though the cartoon's not relevant to investing or to psychology, this academic said, I love that line. And he called it the GI Joe fallacy, which is this idea that people think that having this knowledge is going to help them combat it. It might help a little bit, but it's not anywhere near half the battle. And there's been other papers that have referenced this. One most recently out of Harvard and Yale from professors back as recently as 2021. They outlined this idea of encapsulated biases and attention biases. But I just think it's funny. If you ever run across the GI Joe fallacy, you'll know what that means. All right, I'm going to leave you with a little bit of we're going to shift gears here a bit as we wrap this up in the next few minutes. But this idea of efficient markets is something that if you're familiar with dimensional and Allodium, you're probably familiar with the concept versus irrational markets. Okay, so we've now described how all these people make these decisions irrationally. How do we reconcile these two things, or can they be reconciled? I think in the circles I'm in, the academic circles, the halls of the University of Chicago and the Ivy Leagues, there's oftentimes these two things are pitted as a debate, right? They're trying to convince each other that the other's right. I don't like that, and I choose to ignore it. What I say is that they're actually really both important. But here's the analogy, right? Or metaphor. Investing's a journey. You need a car for that journey, but you also need to drive that car right. What efficient markets does for us is it tells us how to build the right car for our journey. What behavioral finance tells us is it tells us how to drive the car. And you got to do both right to have a successful investment experience. And if you look at FAMA on the efficient market side, University of Chicago, a friend of mine, a board member at Dimensional, has been involved with the firm since day one. Dick Thaler, his good friend, former tennis partners. I think they played golf a few times. These guys are in the same building in the University of Chicago, and they're colleagues, right? And yet they occupy these two different realms. And even they sort of have acknowledged that behavioral finance has definitely been additive, but it hasn't replaced efficient markets. They're still both important areas of study, and they both won the Nobel Prize for their work in their respective fields, which I think is kind of fitting. So this is not new stuff. I've already talked about the tulip bulbs in the 1600s. I've talked about the bubble economy of 1720 and Sir Isaac Newton. This doesn't go that far back, but it's still, this is more contemporaneous. It's Ben Graham. It's the 1940s. He wrote The Intelligent Investor. This is the book and the mentor that made Warren Buffett who he is today. But even in this book, which talks about ostensibly how to beat the market through stock selection and securities analysis, even in this book, he talks about investor behavior, that the chief problem, your worst enemy, is likely going to be yourself. So one last reading. This is hardly comprehensive, but I love this book. If you haven't read it, it's fun. It's by Fred Schwed, who was a Wall Street broker back in the 20s, 30s, and 40s. And to my knowledge, I think he only wrote this one book. But he had this great framework for this idea of if you take that intuitive part of you and apply that to investing, That's speculation. You got to take the real unemotional part of you, and that's actually investing, not speculating. He doesn't talk about them as if they're two different types of investing. He talks about them as different things. Not that one is right and one is wrong. They're just different. So speculation is something that people might think is fun to do. And if you pick a few stocks or try to time the markets or buy some leveraged ETFs, you do that with your fund money, not your life savings, sort of your nest egg money. And I created this narrative of these two different things. I would argue we all have both of these. This isn't like, oh, follow me and my faith and my sorry, call it religion is the investor's narrative. No, no, no. I think I have both of these in me. I think most investors, most of the clients of our advisors have both of these in them, which is this, on the one hand, it's this intuitive idea, investing is a game, but really investing is just capital. There's a long-term return for those who are patient and diversified. You don't outguess the market, you focus on the long term. Very easy to say, very hard to do because of the emotional pull and the pattern seeking and the overconfidence and all the other hindsight bias issues that we talked about. The speculator does have to concentrate. That's kind of part of the game where the investor wants to basically cover all their bases and know that's the right decision. Avoiding losses versus accepting the appropriate levels of stocks and bonds and cash and alternatives. You tolerate higher turnover in pursuit of that concentration. Whereas on the investor side, we're going to focus on the things we can control. We can't control how the market's going to react to tariffs. We can't control how the market's going to react to a geopolitical event or a war or China or Russia or something. But we can focus on the amount of money we spend and the taxes and the budgeting. And then finally, I think this is really where it kind of like gets real for me, is the speculator's narrative is tough. We got to be reacting constantly to new information and our own emotions and our own interpretation of that information. Whereas the investor's narrative is way more peaceful, right? It's about sticking to a plan. And I would say, if you don't remember anything else I said today, it's this. Sticking to a plan is making a decision. You are doing something by sticking to a plan. It is not this idea of, well, don't just sit there, do something. You are doing something. You're not just sitting there. Sticking to the plan is a decision, and it is not always easy to do, but it is almost always the right thing to do. So I'll wrap this up. I think this is, sorry, I've got the wrong slide here. I wanted to share a different slide with you that wrapped it all up, but that was, sorry, I just ended my slideshow. So let me go back to this as my last one. Now, what I would say is the game plan. It looks like I stopped sharing. So sorry about that. Well, yeah, I showed you that last slide, Eric, so I don't have to pull it back up again. Now I got your handsome face and well-trimmed beard filling my screen, and my slides are gone. So, and that's a great place to wrap up. I think that idea of reacting versus planning is peace of mind. I mean, that's what we're kind of getting at. It's this idea of tuning out the noise. The title of our movie that we released last year, that's a theme at Dimensional. It's a theme with our advisors. It's a theme with our message to investors as well. So I hope that was helpful, Eric. It was a lot of fun going through that deck again. I always appreciate the invitation.
Scott, was super interesting. I always find this topic, I learn new things, and I'm always reminded of things too, because there's definitely, you said it, but yeah, like I think it was a Kahneman that said even though he wrote the book, he still does these things, and I still I have to kind of recognize these in my own life, and whether it's with investing or other things. But we're all susceptible to them, that's for sure.
Yeah, I think that the key for me is we'll all think this way, but we don't necessarily want to do it, right? So it's like if we can stop that part, that's the win. It's not stopping how we think about things, but awareness helps. But you have to, a lot of deliberate practice is required as well. And it's very, I mean, look, I've seen it a million times. It is very difficult to do it as a DIY investor. That's just the truth.
Yep.
The data bears that out. And I think our advisors, one of many things they do for their clients is being their sort of accountability coach
Yep.
is a big part of that.
I agree. We had a client when COVID hit and the stock market, the economy was shut down, stock market dropped 30%, and he was a business owner, so he could see kind of, that what the impact was going to be on businesses. And so market had already dropped 30%. And he's like, I want to sell everything out, go to cash. And we occasionally have a client, that wants to do this, and we're usually able to convince them otherwise. But this was one time he felt extremely confident that this was I think he used the term like this is a lock, like the market's dropping, whatever percent more. Um, so it was one we lost the battle. He sold out, and I think it was 2 days later the market started going up, and within 3 months it had regained all of its losses and kept going up. And we eventually parted ways, but yeah, I don't. He could still be in cash today, if for all I know. I don't know. He was still in cash when he was 9 months later. He was still in cash and confused at what he should do at that point. So it's those type of
Yeah.
mistakes that yeah, having an advisor can definitely save you from making those big errors.
Well, and I think in the stories, whenever I hear stories like that, I'm reminded that, typically when people do make mistakes like that, you don't hear about it a lot because they're not writing books and they're not bragging about it. You will hear about people that did get out of the market right before COVID hit
Right,
and they timed it perfectly or maybe close enough to perfectly. And those are the people that will do most of the talking, or, they'll be on the TV or they're writing articles and books and op-eds and stuff. And so I think it's important to remind ourselves that there is a information asymmetry. You're not going to hear, you're going to, if you just open your ears and listen, you're going to hear a lot more positive stories about market timing and stock selection than you are going to hear negative stories. And
right,
that is an asymmetric problem, right? It's going to lead you to believe that, oh, well, I've compiled all the evidence and it sounds like picking stocks is a really good way to go, especially if you leverage them, because boy, people seem to be really killing it. Like, yeah, be careful. Because the ones
right.
that aren't killing it, the ones that are, kind of with their tail between their legs, they're not doing a lot of talking.
Yeah,
And I think there again, once academics get involved and they study broad, controlled groups, they find that that type of activity is, I think many people have said it. Even active managers have said it. People like Peter Lynch, more money's been lost trying to avoid market crashes than has been lost in market crashes.
hmm,
Whether that's a true statement or not, nobody knows. It'd be impossible to measure, but it sounds right to me.
right. I agree. Well, Scott, it doesn't look like we have any more questions coming in, so maybe we'll end it there. Greatly appreciate your time today. It was very informative.
Thanks, Eric. Appreciate it.
All
Thanks
right.
for having me on.
Yep. Take care.